Welcome back to Unleashed with Mark Morano. All right, well, joining us now is Rebecca Walser of the Walser Wealth Management. She's the president of that. She's also a financial advisor, tax attorney, and author of the book Wealth Unbroken, Growing Wealth Uninterrupted. Welcome to the program, Rebecca.
Thanks for having me, Mark. Glad to be here.
All right, well, let's start out with a simple question. Given the fiscal financial health of the United States, both in terms of the government financial health and the citizens' financial health, what would you grade each? What individual grades, if you would you give government financial health, and what would you give us, U.S. citizen financial health?
So for the government, I'd definitely give them a D at this point. And that's for a couple of reasons. Data I can point to it. Fitch obviously downgraded our bonds, so that was huge. But we also had Moody's turn outlook negative, and both of them stated that the state of budgetary ability in the United States Congress and the ability for the government to actually fund its operations or not fund its operations is the problem. And it's obviously, Mark, been something that we've been following since 2008. We've had a shift to modern monetary theory in 2008, and now we're starting to really see the impact of that. And the Fitch downgrade and the Moody's negative outlook both speak to that, so that's definitely a D. Also because we had to pass the buck on the debt ceiling till past the election, which as a lawyer I think is completely unconstitutional, but there's another problem with government. So that's a D. As far as consumers go, we're looking at a C for them, and the reason they're a C is because you really have a bifurcated economy. You have people that are at the top, still doing very well, still supporting retail, luxury sales, and all those things. But if you look at the rest of the America and the rest of the population, we're seeing the highest credit card debt level ever in the history of America. We're seeing the delinquencies go up astronomically, and we're also seeing the high interest rate car notes go into major delinquencies and defaults. So we started to see leading indicators on the consumer side that we're going to have a lot of problems coming in the very near future, and so that's also a C. And also the savings rate. We know that, with the coronavirus stimulus, we had people building up the bank accounts, and now that has dwindled down, and we're really looking at liquidity issues coming forward into the next year.
Okay, well, let me ask you, let's refine the question. Of the bottom 70%, let's take out the top maybe 25, 30%. How is the bottom 70% of Americans doing? Would you still give them a C, or are they in D minus territory at this point because they're struggling?
Yeah, I would say that we would be closer to the D range on the bottom 70 if we didn't have any of the upper pulling us up for a better grade. I think you're 100% right. It's because, inflation, unfortunately, has really been skewed, obfuscated, I would say. The Bureau of Labor Statistics and all of the things that are really following jobs and everything. What they did is, and people don't realize, is usually CPI is a 2-year look back, and they really changed it to be a 1-year look back. So they're looking at it versus 2022 as opposed to versus 2021. And so it looks like it's coming down, but it's still actually an inflationary environment. We're still actually having higher prices than last year, even 2022. It's just that the rate of increase has slowed a lot. And if you compare it to 2022, it looks positive, but when you compare it to what's really happening, you really understand that we still have inflation, and that impacts the bottom 70% immensely because they're heavily reliant on high interest rate credit cards that go up every time interest rates have gone up since, we started having the raises in 2022. So it really is a desperate time. A lot of people are having to have 2 jobs just to maintain bills, and that's a problem.
All right, let's go back. I remember Bill Clinton's second term. I hate to call it a utopia, but it was probably the greatest. I could be completely wrong here, but this is, as a layperson, my memory. His second term, say 97, 98, 99. I always say it's always good when government's distracted by a sex scandal in Washington, because they generally, and you have gridlock because you had a Republican Congress, Democrat president. Mm-hmm. But it seems like, I remember gas in the D.C. area, 75 cents a gallon. We had budget surpluses. We had spending under control. We had welfare reform. There were things, we were still talking about the peace dividend from the end of the Cold War. Obviously, September 11th, 2011, blew all that up. 2001 blew all that up financially. From a point of view, then we had Iraq, Iran, all the military buildup, just massive deficit spending went through the roof, which then later we had the 2008, obviously the banking crisis, or whatever you want to call it. What are those two items? First of all, do you agree with the assessment that the late 90s were some of the best periods of the last, say, 40, 50 years in terms of fiscal health, even among consumers and government? And what was a bigger impact, the 9/11 with all the wars starting after, or just the banking collapse in 2008 in terms of ruining our financial health?
Great question. So I totally agree with you. Bill Clinton was probably one of the most fiscally responsible presidents that we've had in the modern era, and certainly having a balanced budget, which really hasn't happened since, that is something that we need to ascribe to, Mark. We shouldn't be able to debt finance, especially when our debt is beyond $30 trillion. There's got to be a stopping point. I would say that definitely 2008 has a much bigger impact for monetary policy, and I'll tell you why. Because even though we had, the wars and we had a lot of debt financing of Iraq and post 9/11, really, when we had Bush as a president, I'm a more libertarian as a lawyer, and I will just tell you that Bush was probably one of the worst presidents from a perspective of human protections and citizen protections, because after 9/11, we got the Patriot Act, we got what we call national security letters. People don't even know that the government has the ability to send a request for your cell phone records and your bank records to your bank or your cell phone carrier, and they're not even allowed to tell you that they're providing those documents to the federal government. So I'm not a big George Bush fan from a perspective of freedom, but monetary policy really did not change until the global financial crisis of 2008, and that is what has really set us on this collision course for reality. We might have been able to get away with it a little bit longer, but what happened in 2008 with too big to fail was we have to bail these out. And I'll give you a perspective on that. We thought back then, wow, the government's going to come into these banks and basically buy these toxic assets. That was $800 billion, Mark. That wasn't even $1 trillion. Fast forward to coronavirus in 2020, and we're at $6 trillion just with the Congress stimulus alone. Before the Fed is coming in and printing. So what happened was we literally changed under the Obama administration beginning in 2009. We really changed our philosophy to be one of modern monetary theory, MMT, which basically completely disconnects your currency to your hard asset values. And it states that you're able to print as much money as you need to perpetually into perpetuity as long as you can collect enough taxes to service the debt. And that is a theory that has never really worked out, because if you look at like the Roman Empire, for example, that had massive wars all across the globe that were taxing their citizens to the point of desperation, it imploded upon itself. And that is the United States of America in 2023. We have such a large debt level that it is just not able to be sustained. The Treasury Department came out on December 1st and said that they would have to raise $1.6 trillion just between November, December, and get into Q1. $1.6 trillion. So what we have now is deficit level, pandemic level spending under normal circumstances, and this is not manageable. This cannot continue into perpetuity. So the United States has a reckoning, and it is coming.
Wow. Okay, let's go. I was working in the U.S. Senate 2008 when they were trying to do the bank bailout. This was in the waning months of George W. Bush's administration. I worked for Senator Inhofe. I actually had meetings with him begging him not to even consider the bailout. He ended up voting no on the bailout. But later I had found out that whole bank bailout, they were going to get the bailout whether Congress voted yes or no anyway. Congress was more of just a symbolic, gesture as a vote of confidence. What did they do with that bank bailout that the financial industry got? And didn't that send all the wrong lessons? Would that just mean basically you can do whatever you want and you'll be bailed out by the U.S. government?
This is it. Too big to fail basically creates what we call the moral hazard of banks, and they haven't learned their lesson, and we're doing it again. We did it again with what we call the BTFP, the Bank Term Funding Program, that was opened as a credit facility for the Federal Reserve to get direct cash to banks. In March of this year, it's a one-year program. The analysis through JP Morgan basically said that they expect that to grow to $2 trillion. Now, I want to explain to you, if you look at the FDIC's balance sheet for 2023 and you look at the reserve assets that the FDIC has in reserve that ensures $9.9 trillion of deposits, just under $10 trillion is FDIC insured in this country. The FDIC reserves on their balance sheet is $125 billion, ensuring almost $10 trillion. trillion. So the BTFP, the Bank Term Funding Program, is a direct dollar for dollar. Basically, the Federal Reserve will buy back the bonds because there's been a shift since we went to modern monetary theory. A lot of these banks have insured their deposits not through loans, not by saying, hey, let's take in risk, make loans, make a profit, pay, get a yield spread, and then, that's how we operate as a bank. What they have started to do is buy bonds to basically cover their liabilities of withdrawals. And the problem is they bought those bonds prior to the 2022 rate increases, which means they have lost a substantial amount of market value when you compare to current market value of those bonds. And the Fed is ignoring all of those trillions of dollars of losses and saying, we will buy your bonds back at par. And the Fed doesn't have the capacity, with the balance sheet of over $7 trillion, which is literally the highest in history, except for the time right after coronavirus. It's come down a little bit. You'll see that they don't have the capacity. And we were following really sort of Paul Volcker 80s kind of monetary policy when we were raising rates. But what you'll see is, even though we've quantitative tightened the last 6 months and we've pulled off about $600 billion, the Federal Reserve injected money in the last couple of months back into the system that pretty much undid all those 6 months of QT. So we're really moving back towards the Federal Reserve having an accommodative policy, at like a Ben Bernanke policy that we did have in the 2008 global financial crisis, that says we're going to cut rates and they're going to buy these things and stimulate that way. So they are really moving us right back to MMT because they understand that our country now will not survive without it. We are a stimulus-based economy, a consumption-based economy. And if the liquidity dries up at the banking system, it's all holds barred. It's a complete financial collapse, unfortunately, and they can't have that happen. So we're moving back to MMT and we're back to stimulating.
Okay, first of all, what's the history of MMT? Where did it come from? Was it a few academics? Why was it so readily adopted? And where is it, assuming we stay on this path, how long do we have till that collapse happens? Are we just delaying it 5-10 years? Is this inevitable, or is there a way out potentially, was there a way out staying somewhat the same course with the same type of thinking in charge, or do we have to completely revamp our thinking and approach?
All great questions. I'll try to take them one at a time. So MMT really was a brainchild in the 30s of an economist, but really became more popular with, John Maynard Keynes and the Keynesian philosophy of, we believe that the government doesn't have to collect and can be printing, and that there will not be a problem as long as the collection ability of the tax is enough to service the debt. So it really became popular in modern era under Keynesian. And as far as where we are, the problem is the United States has really enjoyed the hegemonic status of the dollar as the world reserve. It really goes back to World War I and the 1917, 1918, because the pound was literally basically what happened in World War I is people were buying. We became an industrialized nation, and people were buying from the United States in U.S. dollars. So a lot of global trade started just naturally occurring in U.S. dollars. So a lot of people attribute the dollar standard to really the World War I. But the truth is, we didn't really get it until Bretton Woods, Connecticut, 1944, where we were officially then tied to the gold standard and became the global reserve currency for the world. Since then, if you look at the Forex percentage of dollar denominated, we still are by far 75% plus the majority. But what we've seen is a sheer diminution over time of other currencies being held as reserves. Euros, Japanese yen, a little bit of Chinese yuan, that's very minor. And those are the kinds of things. But what has happened is the shift of the world. And that is the bigger threat right now, Mark, is you have the G7 GDP that you can look at. And then you can look at what we call the BRICS nations, the BRICS bloc, which was Brazil, Russia, India, China, South Africa. And they have, as of January of 2024, admitted Saudi Arabia and the United Arab Emirates, UAE. Now, that is extremely alarming because the way that we solved coming off of the gold standard in 1971 under Richard Nixon was we created the petrodollar in 1974. Henry Kissinger went over to the king of Saudi Arabia and said, we will be your military as long as you control the OPEC bloc and make sure that all crude is sold in US dollars. And that gave us a quasi-asset backing 3 years after we officially came off the gold standard, and it made the dollar very stable globally. What is happening now with these BRICS nations is that we're seeing a much bigger block of the world's GDP moving away from the United States and the Western SWIFT system, which all came about when Russia got kicked out of SWIFT when they invaded Ukraine in March of 2022. So that set off a series of events, Russia being a part of the BRICS nations, to start to bypass the dollar in global trade. And that is probably the biggest threat that we have, Mark, on time frame. How fast is this going to happen? Because if Saudi Arabia and the UAE tell the world that they will start selling crude outside of the US dollar beginning this coming year, then we're looking at a potential dollar collapse that could be realized. And that is something that we are not prepared for in any way.
Well, yes, I've heard a lot about that. Now, in terms of the BRICS nations versus, say, the G7, are the BRICS nations, what are their financial health? What's their financial policy? What's their inflation rate? Do they buy into modern monetary theory? And are they actually learning from our mistakes? And what kind of threat do they hold down the road, aside from the dollar? I'm just saying, how are those nations' fiscal health being governed right now? The BRICS.
So it's a great question. It's a very great question. What I would say is with the addition of Saudi Arabia, UAE, and Iran, which are joining in January, and we have other countries that have formally applied to be a part of that bloc, what we are seeing is the GDP of the BRICS bloc is going to now exceed, and it does already, the GDP of the G7. And so we are talking about a substantial amount of the global world trade being not potentially denominated in dollars as the BRICS nations get their alternative reserve. And they've already said that they are going to back their currency by hard metals, gold specifically, and rare earth minerals, China being the largest miner of gold and rare earth in the world. China is definitely a modern monetary country. They are all about government stimulus and support, and they obviously artificially increase their GDP and their growth every year through their government funding, because it is, a communistically run country that, even private business is not majority owned by private business. It's a kind of a consortium with the government. So it's a totally different business model. They definitely are a modern monetary theory, and they have a big problem coming with their real estate. But if you look at Russia and you look at the other countries that are part of the bloc, you've got a mix. And the truth is, it isn't even about does that country have fiscal solvency or not. It's about the fact that we have this whole pulling away of the East and a lot of other countries with them that exceed the GDP of the G7, and that is a big problem.
All right, we're talking with Rebecca Welzer, the president of Welzer Wealth Management, and we're going to talk a little bit about central bank digital currency when we come back. This is Unleashed with Mark Morano on TNT Radio. Stay tuned.